All right, welcome back. We're just going to go through some of the benefits and what separates real estate from some other investment options out there. So this is basically a nice, clear, simple to understand graph and puts out the basic difference. So real estate, commercial and residential, when you're buying a property and renting it out, it's going to produce high cash yield. It's going to have equity buildup by the renter is going to be paying down the mortgage for you automatically. You're going to be able to benefit from leverage. So you can put down, I'll show you in a bit, you can put down 5, 10, 20% and be able to buy, the bank will give you 80% of the money. It's a hard asset, so it often, even if it burns down, you can just get it, make sure you got really good insurance, and you just build it right back up again. So real estate is a hard asset, doesn't tend to disappear. And then there's certain tax advantages in Canada. We can make our mortgage tax, principal mortgage tax deductible using this what's called the Smith maneuver. And then we can borrow for investment purposes, and that's a tax deduction as well. So again, some of the other things, stocks can benefit from equity buildup, but a lot of the other assets, stocks, bonds, cash savings, it doesn't have the full effect as real estate does. Next is this is a financial planner blog from he's a fellow out of San Francisco, and he put together this this presentation or this blog post. And the interesting thing is he recently got started doing fix and flip real estate investing. So he would purchase a property, fix it up, and then sell it for a profit. So he most financial planners would say real estate is risky because they're financially compensated because they sell stocks and they get the commissions that way. So this guy is, the interesting thing is he's able to look at it both sides because he's both a financial advisor, plus he's also a real estate investor. So this is his basic analysis of nine reasons why real estate is better than the stock market. So he's also got a website, or he's on his webpage there, he's got a blog post of 10 reasons why stocks are better. So it's just a little bit, read both sides of the story. So number one, you're more in control of your real estate. So again, if you own shares in General Motors or Bre-X or certain other corporations, Enron, that do bad things, that corporation may not be around and your investment may not be protected. Whereas in real estate, you own it, it's yours. Tax advantage, again, I mentioned that. Easier to analyze and quantify. You can have an appraiser come in and say it's worth X amount, and then 2 or 3 other appraisers come in. They're going to be generally around the same price. It's a source of pride. Government tends to be on your side. They will protect your rights of ownership. You are able to leverage other people's money. We'll go over that. It's a tangible asset. So it's actually there. Less visible market volatility, and we'll go over when there is volatility, how to protect yourself next. And then it's basically more insulated. A lot of real estate markets, most real estate markets, all real estate markets are local. So they're just generally in their local area, and that's how they're larger things. If there's a war in certain other parts of the world, it doesn't really affect our real estate that much. So long term, what's happening is with the average Canadian household net worth, as you can see, the chart says it's going up and up and up and up and up. Basically, this is tied in because to hold a net worth, you need to have a house and a home. And so as the value of your home goes up, your net worth accordingly goes up. And so you look at this math, actually, if you bring this up to 2015, it's about 900%. And so then we have values, assets, of 900% of our income. And whereas, you always hear this complaint, oh, Canadians are 160% debt. So this is 350, 160 would be down here somewhere. So basically we have $9 in assets for every $1.60 we have in debt. So the bank would loan us money all day long as that's the case. So as Canadians, we're very well protected. As you can see, the average residential house price across Canada. So as you can see, around 300, and it's now a little bit above 400. It's not going crazy. It's actually, people think it's going up massively. It's not. It's just going up on a steady curve. So that's basically what's happening. Financial net worth comparison, according to CMHC. So they've done an analysis a number of years ago. So the average and median net worth of renters, someone renting, is $14,000. The average median net worth of homeowners is $327,000. So as you can see the difference, you want to get started to increase your net worth through stopping renting and getting out there and getting on the property ladder and start buying something to live in. So the interesting thing about this is they haven't even updated the statistic. This is I checked the website. It's only available up to the year 2005. So it's not really something the government's very proud of or want to publicize that much. So the numbers are probably even, net worth of homeowners is even more in 2015, and I don't think the net worth of renters is very much more. So as you can see, it's net worth here and then average, basically. So the difference between median and average, very briefly, is if Bill Gates is in a room with 60 people, the average net worth of the room is $1 billion because Bill Gates divides his 60 billion divided by 60 people. So that's how average net worth versus median. Median's a more accurate number. Median is a more accurate number. So that's how the net math works. We're even as bad as our numbers are here in Canada, they're even worse in the States. These are the numbers from the States, U.S., United States. So it's $2,000 or $3,000 net worth for the average renter, and multiple thousands of dollars net worth for the average homeowner in the States. So different systems. So a home is your largest financial asset most people have due to equity and appreciation over time. So according to TD Bank, the average annual appreciation rate nationally over the last 100 years is 5.1%. Again, local rates vary. So Saskatchewan may be different from BC, which may be different from Manitoba, and a different city would have different appreciation. So even at, though, an average annual appreciation of 3%, a home purchase for $300,000, the average Canadian price, would grow to $728,000 over the next 30 years. Even at a 1.5% annual appreciation, the same home would still grow to $469,000 in 30 years. So this is the math on the average of our local market. So this is, as you can see, Vancouver is just glowing slow and steady. What is separating it substantially is the detached houses. So the red here is these are townhomes, and the green is condos. So as you can see, the price of land obviously is going up and up and up, and that's kind of what's happening in our marketplace here. I believe the latest statistics from last month were the average home price is $1.4 million here in Vancouver. So start getting involved and using the equity and leverage that you have, and start getting involved with buying investment properties and buying your first place. So what's really going on with these numbers was, as you can see, the nominal prices goes up and goes down and goes up and goes down. It's called the real estate cycle. And so basically what it ties into, I would argue, it goes to inflation. So if inflation's 3%, real estate prices go up 5%. And so it's a counter, or it's goes alongside the actual inflation rate. So that's basically, they print more money and the supply of hard assets goes up in price. So that's basically what's causing real estate prices to tend to appreciate long-term. Long-term population growth, we are adding more people into Canada, either through immigration and through natural birth. So that means more people to buy your houses that you buy and rent out from you. Canadian rate of inflation, as you can see, it's about 2 or 3%. It's also, there's a website called shadowstats.com, and you might want to take a look at it. The actual real rate of inflation, if they included everything, is about 4 or 5% right now. Well, it's about 4 or 5% above the posted rate of inflation of 2%. So if you have all your money in the bank account and you're earning 0.65% or 0.75% of interest, you're going to be falling behind pretty substantially. So inflation's a lot higher than we have credit for. Conventional mortgage rates have never been lower, especially the lowering they just made the last couple of weeks. And so the price of money's never been cheaper. So borrow to give the banks giving you very cheap money to borrow and buy real estate, especially investment real estate. Projections for home ownership, aging population, and there's new home buyer growth. So what if, again, I always like to explain what if everything collapses. So this is actually your friends down south again. This is the United States. So this is what happened to them. Their market actually collapsed. So basically it came along. It was growing about 3 or 4%, or actually 5% on an annualized basis. And then late in the 1990s, Bill Clinton's the president. He's in office. And he decides that it would be nice for his legacy if the number of homeowners in the United States went up under his leadership. So him and the Congress voted to loosen what are called their mortgage rules in the United States. And so what they did is they made what are called ninja loans. So I don't know if anyone knows what that is. It's basically no income, no job, no assets, and you can get a mortgage down in the States. So ninja loans, N-I-N-G-A. So as you can imagine, as all those loans and mortgages came into the marketplace, prices went up because more demand would increase prices. So prices go up, 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 up. All these are interest-only mortgages. And what happens in the year 2000 is all these 5-year interest-only mortgages all reset. And so someone's mortgage payment went from $1,000 interest only to $2,000 or $1,800 interest and principal, and no one could start paying these off, or a large chunk of the population could not pay those mortgage rates off, and so the prices start collapsing. Anyone they go into foreclosure, and that's kind of what happened. But as you can see, the prices fell until they come back to the long-term average annual growth rate, and that's where they're going to be at right now. So in Canada, if we have a quote-unquote bubble, this is basically what would happen to us. Prices will just return back to their long-term annual growth rate. So what happens if something actually happens? And so I've got a nice little strategy. I've learned it from my financial planner that used to be a financial planner. Now he bought a real estate brokerage down in the States and using his Canadian company to do that. So he taught me this technique. Basically, it's hedging against it. So if you've heard the term hedge or to hedge your bets, this is very similar. Basically, it's that you invest in a counter-cyclical either mutual fund or ETF or a bear market index fund that bets against the market. So, for example, this one's in the States, this one's in Canada. So these companies bet against the real estate market. So as you can see, the long-term average is, ever since 2008, the prices of real estate have gone up and up and up in both markets. So as you can see, these aren't great investments when the market's going up. So this one's like this one's about $5 and this one's about $2. But what happens in 2008 when the market crashed is these things shoot up through the roof. So as you can see, this one went to a peak of about $16, and this one actually went to this $10 one in Canada went up to a peak of $141. So basically, and then I looked at these two index funds, ETFs, the last couple of weeks or a week or two, and as the markets collapsed, they've shot up exactly as predicted. That's what they do. They bet against the market. When the market goes up, these go down. When the market goes down, these go up. So basically, if you're going to invest $100,000 to maybe buy a United States condo, or going to buy a small condo up here in Canada for investment purposes, you can take for every $100,000, take $5,000 and put it into either of these. So if you're going to buy and hold something for 5 years, and 3 years into it, the market collapses, well, guess what? You can sell, have these back you up, and they go through, the price goes to the roof, and you can sell it and actually make a profit during the market crash. So it's basically just an insurance policy. And so I'll go over a little bit more in the rest at the end of the presentation on how to take advantage of them. So to decide to buy, buying your first home is an emotional decision. Home is where the heart is. A home represents your personal tastes and provides a haven of stability and security for both you and your loved ones. It provides a pride of home ownership because it's actually yours. But it's also a rational decision. Home is where your wealth is, your intergenerational wealth. You're able to grow wealth via equity buildups, having the renters pay your mortgage, by debt pay down, and by value appreciation. So in Canada, you can also take advantage of tax-deductible benefits such as non-taxable capital gains for your personal residence and making your mortgage tax-deductible with a readvanceable line of credit mortgage. So I'll go over that in a little bit more detail a bit later. Home is where your wealth is. Home is an accidental investment that creates leverage opportunities. For example, in a couple of years, use your equity to trade up to a newer, better home, or you can use some of your home equity to invest in rental properties or a second home. So that's kind of what I specialize in. So why pay rent when you can own? If you took out a 25-year fixed-rate mortgage for $300,000 and made monthly mortgage payments of $1,344, you'd pay $403,000 in mortgage and interest payments over the life of the loan. And after 30 years, you'd own a home with an appreciated value potential of $628,000 at 3% annual appreciation. So again, in Vancouver, the last 50 years, the city of Vancouver, last 50 years, property prices have appreciated 9% per year on average here in Vancouver. So it's not guaranteed, but that's just kind of what has happened for the last 100 years. So compare that to paying $1,200 a month in rent over that 25 years. Even if your landlord and probably never raised the rent on you, you'd still be spending $375,000 and own absolutely nothing. So next off is we're going to use some leverage. So this is how leverage for real estate works versus leverage for buying stocks and bonds and fixed income assets or fixed income investments. So GIC. I went recently on the CIBC website to check what they're paying for GICs, and because of the lowered interest rates, they're now at 0.75%. So that's less than 1% they're paying for their GICs right now. The bank is. So if you give them $10,000 in a year, let's say improbably, even best case scenario, they gave you 5% interest. Right now it's less than 1%, but let's say they give you 5% interest. So you put down $10,000, you bought $10,000 worth of GICs, you'd get $500 from your $10,000 investment at the end of the year. But real estate, you can leverage. So real estate, you can put down $10,000 and buy a $100,000 piece of real estate. So let's say that real estate went up by 5%, grew. So 5% on $100,000 is $5,000. So basically, you get $5,000 at the end of the year. So $10,000 plus $5,000, $5,000 is 50% of $10,000. That's your return versus the $500 through a GIC. So that's basically how leverage works. Who are the poor in Canada? This is a very troubling statistic, and this is actually what a lot of our neighbors are suffering from, because they didn't make proper financial decisions, or maybe just some bad luck. So as you retire, 41% of single females that retired after age 65, so maybe their husband dies or they're by themselves, 41% of them are in poverty. 31% of males, and so we want to make sure you're planning for your retirement and having strategies in place. So that's why rental real estate is one of the best ways to do that. What do the wealthy do? Conversely, so the wealthy put their assets into real estate, stocks using hedge funds, and money placement. So as you can see, the rich actually don't. People placing more than $20 million don't place their money into mutual funds. So that's saying something. You might want to take note. Why are the ultra rich doing what the regular people are not doing? So they invest in a lot different things than putting their money into mutual funds. So let's find out why. So where are we now with our retirement? So financial planners using more than a 4 to 5% projection rate of return over the next number of years, probably the next 10, 15 years, 20 years. They may be overstating return. So it used to be stocks return between 7 and 14%, not anymore. We're in a long-term, low-growth environment for equity investments. So that's kind of the rule that the financial planners have gotten the instructions from their governing body organization. So use some leverage here. This is just a slide explaining the differences between putting down 5%, putting down 20%, and then paying all cash for real estate. Because some people don't like using debt, but if debt can be used properly, your returns go up. It's your rate of return, your interest, your money you make is not different than the interest that you pay. The interest you pay is just a tool with which to build your wealth. So I'll give you I'll give you a quick example here. We're going to be buying this property at $100,000, and we're going to be paying all cash. And so we're going to be earning 10% an annualized return. So 100,000 in, 10% return, 10%, $100,000 profit, 10%. Next, we're going to put down 20%. So 20% in, $200,000 down payment, $800,000 loan. Annual debt payments, $64,000 in debt payments, and $36,000 left over. But we take the $36,000 in profit, we divide it into the down payment of $200,000, and we get an 18% return. So by putting down 20% instead of all cash, you're making an 18% return on your money. And then you can do it again and again, and the number is even better at different. They're different at 5%. So $100,000 in, $50,000 down, payments of $76,000 for interest, but we still have $24,000 left over on our $50,000 down payment. So cash on cash, return of 48%. So that's how to do whatever you feel most comfortable with regarding your down payment. But this is just how to leverage and get the most benefit, bang for the buck. So this is a financial planner, again, from the States. He hasn't updated his presentation in a while, but it's just a basic analysis of between. You talk to financial guys, and they say, well, yeah, real estate is risky. Stocks and bonds the stock market returns far better returns over the number of years. And what they're actually comparing is the price between paying cash for a piece of real estate, paying cash, and just counting on appreciation, not counting mortgage paydown or rental income, just paying cash for a piece of real estate compared against stocks. And yeah, if you take a look at their math, they're actually right. So the dark gray here is real estate. The light gray is the TSX, so Canadian stocks, and the medium gray is Canadian stocks. The light gray is U.S. stocks. So yeah, real estate in comparison doesn't return as much. But all you have to do with real estate is you can actually put down 50%. You can put down 20% in investment real estate. So if you add the leveraged amount, it actually doubles, obviously by definition, doubles the return. So you can see leveraged real estate far outweighs stock market investment by far. So these are the returns from 2002, 2005. Again, he hasn't updated his slides in a while, but the numbers since 2000, from 2005 to 2015, real estate's gone up and up, and stocks not necessarily have. So that's another explanation. How about rental properties? So this is the math of why landlords get rich. So they buy and hold for the long term. They rent out their properties. They break even, make a little bit of a profit, and over time, the renters pay down the mortgage. The properties go up in value, and this is kind of what happens for them. So basically, we're going to buy a $200,000 investment property. We're going to put down $40,000, just 20%, just for argument's sake. We're going to pay 4.5% interest. We can get interest lower these days. We're going to call for a 5% annual appreciation and then a 5% annual rent increase. So just see what the math is, and then we can see if we can get deals like this that exist. So the mortgage is $810. Property taxes, insurance are about $233. Repairs, we want to make sure you keep your good place in good shape. $167. Rent for $1,200. Net profit -10. So the first year we're not going to make any money. So property value $200,000. But mortgage, then year 5, every year mortgage is going to stay the same. Property taxes maybe go up a little bit. We'll budget for that. Repairs go up a little bit. But the interesting thing is rent. Look what happens to rent at 5% increase every year. Rent's now gone up to $1,540. Monthly profit is now a lot higher, well over $200. And our property market price has gone up 5%, 5%, 5%. So it's now worth $256,000. And $200,000 in purchase price, $256,000 value. We paid $40,000. So 56 divided by 40,000 gives us a return of 142%. So not too bad. Again, year 10 prices go up, rent goes up. So the property is now 329,000. So 129 divided by 40,000 gives you a 300% return. And as you can see, 20 years later, it's paid off free and clear, 800+% return. So this is why landlords just own one property and get rich. But obviously, this is the math. So let's start getting investing in real estate. Interested in developing, so I've got a separate mastermind group on putting together development deals. But this is basically some slides from the presentation. It's buying a lot in a duplex. Just focus on the return, the number over here. So basically, you just find a lot, you tear it down, tear down an old house, build a duplex. The developers make a 43% return in 1 year. And let's just build a house. So we take a house, tear it down, we build a new house. Even just building a new house on an old house, 41% profit year on year. So that's how much developers make. So it's a good business to be in. So if you're interested in that, let me know. So next step, I'm going to pause it for a bit, and then we'll come back to video number 3.